Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter and the Banking on Profits Report, coming to you from down here in Central Florida, where finally, again, the weather is beginning to make a little bit of sense. Back up into the 80s today. Very nice day out here, down here in the Orlando area. And anyway, it was an okay week for stocks. So the S&P 500 is up 1.11%, boosted by a deal in Greece. The All World URTH index is up about 2.09% on the week, as they did finally end the posturing and come to a 4-month extension for Greece and the Eurozone to come to a full compromise deal and get the debt situation in that country worked out so that Greece can get back on track at some point in the future. Market was really worried about a default there or them leaving the ECB. That would have had all type of spillover effects in Europe and possibly even eventually the United States. So at least now for the next several months we don't have to worry about that. In Europe, the same cannot be said for the Ukraine. They are fighting once again. The Russians are not backing off. That ceasefire did not last long enough for the celebratory vodka shots to properly chill. So we'll see what happens with that in the weeks ahead. Of course, also coming up this week as we look ahead, Janet Yellen is testifying before the House Financial Services Committee on Wednesday, and it's going to be a big week for housing as we have both new and existing home sales. You have the Case-Shiller report early in the week and Toll Brothers reports early in the week as well. So that we could see some action in the housing-related stocks during the week ahead. Anyway, rather than cover all the news happens every week, doesn't really matter that much to us as a long-term investor. It's fun to talk about from time to time, and it can get quite interesting. But the real news this week, from my point of view, is I've been playing around with a new screener and back tester that my good friend Tobias Carlisle, who's my go-to guy for screening and testing stuff, told me about it. I've got a little free trial going. Not sure if I'll sign up for the whole year, but just like the Zacks screener a few months ago, sure having a lot of fun with this. This one's a little bit more comprehensive, so I was able to test some of the screens that I actually use day to day to run my business in the newsletter portfolio. So, first, what we did is we went back and we tested from uh, 15 years, 10 years, and 5 years the data for the perfect stock screen. Now, those of you who have been following me for a while know that the perfect stock screen is real simple. The stock trades at a discount to book value, has a very low debt to equity ratio, has a current ratio of at least 2, is currently profitable, and also pays a dividend. It's the perfect stock. Financially strong, dividend paying, profitable, and cheap. So we went back and we tested this. The numbers are absolutely fabulous. Over the 10 years, last 10-year period, starting with 221 of 2010 through today, you've got results that are just about 50% better than the overall stock market over that period of time, compounding at 9.31% compared to the broader market's 5.95%. Pretty good numbers. Now, the maximum drawdowns where it gets interesting because, of course, this does include the credit crisis, and you had a 57% drop in the S&P 500 from top to bottom at one point. The screen largest drawdown was just 38%. Not only is it more profitable, but when things go to where in a handbasket, it's just a little bit safer, I guess is the word that we'll use. Now, the drawdown assumes being 100% invested. The actual drawdown in practice, if you're using any type of position sizing rules, would have been far less, and here's why. If you look at this stock, at this screen, over the last 10 years, starting at about the November 25th, right around Thanksgiving of 2006, the screen was finding almost no stocks, single digit number of stocks, 5 or 6 or 7, and it lasted that way all the way up through 10/29 of 2007. There's no way you were fully invested coming into the credit crisis if you're using any type of common sense position sizing rules at all. Um, Now, once we got to November of '08, I'm sorry, October and November of '08, we popped up to where we started having 60 and 70 positions at a time, which is on the high end of the range. So using this strict value criteria, as markets move higher, there's nothing to buy, and the stocks that you bought a few years ago are getting overvalued, so your cash levels are rising and rather rapidly at that. So you've got a huge cash cushion as you come into the drawdown period. And then as everything starts to fall apart, everybody's panicking, they're getting out of stocks, the world's going to end, the news is horrible, the screen's finding a lot more stocks and you're getting more and more and more fully invested as the market bottoms. This is not a precise market timing thing, but it sure does have you doing what everybody claims to do and nobody does: buying low and selling high. You're not chasing stocks higher when you pay attention to the rules. Now, when we go to the 15 years from 2199 up through today, so I guess that's actually 16 years, you've got a 10% rate of return for the screen versus a 3.41% rate of return for the overall stock market. And again, that's the drawdown figures stay the same, but that same kind of gradual timing element happens coming into the internet bubble when we go back and look that far. From 10/9/99 to 5/18/02, 2.5 years, long period of time to be holding a lot of cash, but we've been there, right? So only 1 or 0 stocks is found by this screen. It is a very strict, rigid screen, really hard to pass. So there's never just tons of stocks except at market extremes. Now, by 10/15/02, there were 49 stocks, which is getting on the high end of the scale. Usually there's 25 to 30 stocks, in normal market conditions. At this market bottom in '02, you've seen about 49 stocks. At the market bottom in '08, you were actually seeing closer to 80 stocks passing the screen, as there was just bargains everywhere you looked at that period in time. And your average portfolio turnover was just about 20% per year. Not too bad. So looking at all this data, this perfect stock screen beats the market, reduces your overall risk, cuts back your exposure in markets that are extended and have been rising for a long period of time, and increases your exposure at or near the bottom of bear markets. So that's definitely something to consider. It's a big part of the way we run the portfolio, and a lot of our stock picks are based on fitting that perfect stock definition. So now we went back and we applied basic Walter Schloss rules: safe, cheap, not a lot of debt, insider ownership, real focus on the margin of safety in the balance sheets, and buying at or near lows. So we ran the 15 years here. We get 14.32% for our screen versus 3.41% again for the overall stock market. Drawdowns, pretty similar. They were actually pretty within a couple percentage points of each other, the screen to the market. So the Schloss screen did not reduce drawdown risk as much as the perfect stock screen does. However, again, you are forcing yourself out as markets go higher, and you're buying more as markets go lower. Now, we cut the screen off at, and again, this is three times the market's rate of return basically over a period of time. We've tested it and found that the rate of return holds over very long periods of time. If we add back in the ones, because we cut it off 25 million market cap and higher, if you put the 25 and under stocks back in, the returns on this thing, I'm not even going to say what they are, they're too high. They're astronomically high, because the gains coming off of the bottom in 2002 and the bottom in 2008, there were triple digit years the next year, and close to that the year following that, when you include these micro cap stocks, which might make a case, and we may have to go back and look at this, at buying the micro cap stocks that fit the Walter Schloss screen, because coming out of a bad market, the returns are astronomical. That's been the truth in practice as well. Maybe not quite that good, but pretty doggone good, which is why we hold as much cash as we do right now, looking for that type of panicky bottom to produce at some point in the future, the type of sell-off that will make Andy Beal come back from Vegas, park his NASCAR toys at the track, and get busy buying undervalued assets again. And we'll don't know when it's going to happen, just highly confident that at some point in the future it will happen. Now, naturally, now we had to go down and test the granddaddy. We went down and we tested, real simple test, guys. Banks under 90% of book value. And I haven't learned to run the formulas well enough to do anything else. So banks under 90% of book value, lower market caps under 250 million. Well, 10 years, 23.55% for the banks, the 5.84 for the market. 21% over the 16 years versus that 3.41% for the market. Drawdowns, the small banks in '08 had tremendous drawdowns. The one thing that I will say is that we have no safety criteria on this thing at all. There's no check on non-performing assets, non-performing loans, equity to asset. It's just banks that are cheap. So in '08, the drawdown was actually in excess of the market by quite a bit. Not something you want to come into leverage. But you had that timing effect again. Single digit numbers of banks actually qualified for the stock screen as we come in to 1999, lasting through June of 2002. There were very few stocks that actually passed the criteria. Single digit number of banks, 4 or 5 banks at most each month actually met the screen. Now, from June, of '07, single digits. There were no stocks to buy, and that did not get better until 2008 when that number of banks started to creep up. As you came into 2007, I can tell you there were no cheap banks. There was nothing trading under book value of note at all. Takeover multiples were up around 2.5%, so your average bank stock was flirting between 1.75 and 2 times book value, maybe 25 times earnings. There was literally nothing to buy, and most of what you held, you were happy to sell at those crazy valuations. So again, there's a natural timing effect to using the value screens, but the best performer is these little community bank stocks. And it comes back a little bit to Roger Ibbotson's study of the value of illiquidity. You're not trading in and out of these things. You're not trying to capture 2 and 3 point gains. You're staying in as valuations rise, book values rise, multiples of book value for takeovers rise, and you're getting a long-term compounding effect by owning these smaller bank stocks. A 23% 10-year return, 21% 16-year return just from owning teeny tiny banks, 3 and 4 times the rate of return of the overall stock market. It is a puzzle to me why everybody is not invested in the small community banks. All of the evidence points to this as one of the most successful investing strategies in the history of the markets. It's one of the things that drove Peter Lynch and the Magellan Fund to such high rates of return while he was the head of the fund back in the 70s and 80s. Everybody talks about his experiments with, owning what you use and the legs pantyhose thing and all that. Mr. Lynch had a position in just about every small bank and thrift in the country, and it was a huge part of the very high rates of return he earned while managing that fund. You need to be in this, even if you're a short-term trader whipping in and out every day, every minute. You need to have a portion of your long-term, say your retirement or your kid's college fund, in these small banks. If you're an average investor, going to work every day, running a business, a profession, a career, or you're a retired guy at home that wants to spend more time with his grandkids and on the golf course or fishing or whatever, this is a low-maintenance portfolio. Where because of the way the valuations work, you'll be out of the market when you need to be out of the market. You'll be in when you need to be in, which is most of the time. And you'll be in safe, cheap little local banks. And even if you get the urge to day trade them someday, you won't be able to because the liquidity's just not there. Illiquidity is the best friend that you have as an investor. The situation in small bank stocks, we are ripe for another one of these long, extended consolidation waves that's going to last 7, 8 years or longer. And there's an enormous amount of money to be made. Once again this week, the buy list was about 30 stocks. We added two stocks to the portfolio this week, both trading under 80% of tangible book value with adequate capital ratios and very low loan loss rates as a percentage of total assets. So the opportunity is there. You need to be taking advantage of it. History tells us that it works. It works extraordinarily well. There's less risk, less volatility. You need to be buying these things. Anyway, as I said, it is about 80 degrees out here today. Looking around back here, we are back in the last 12 laps of the Daytona 500, so I'm going to go watch and see how this thing finishes, and I'll talk to you guys next week. This is Tim Melvin of the Deep Value Letter and the Banking on Profit Report. Have a great week, everybody.